Welcome to Iron Financial, the channel where we help you forge a stronger portfolio. You know, after an earnings report drops, it's like a trial by fire. Some companies emerge tempered, stronger than ever. Others, they just shatter into pieces. Today, we are putting a very interesting fintech player, Paysign, ticker PAYS, to the Forge test. They just dropped their Q4 2025 numbers, and let me tell you, the market didn't just notice. It reacted with some serious force. So let's break this down and see what's really under the hood. All right, let's get right into it. This number, this is what got our attention. Plus 12.87%. That's a nearly 13% surge in the stock price in a single trading day right after they release their earnings. Now, in this market, anytime a company beats revenue expectations, it's going to get a look. But a move this big, this fast, that's not just a small beat. That tells you the market saw something it really, really liked. But for us here at Iron Financial, a big green candle like that isn't a conclusion. No, it's the beginning of an investigation. It forces us to ask the hard questions. And that really is the heart of the matter, isn't it? I mean, anyone can get excited about a one-day pop. It's fun to watch, but that kind of short-term noise means absolutely nothing when you're trying to build a long-term resilient portfolio. So we have to ask, is this just market hype? Is it just a bunch of algorithms chasing a positive headline, a momentary flare-up from the Forge that's going to cool right back down by next week? Or is there something more here? Are we witnessing the real structural foundation of a defensible fintech fortress being laid brick by brick? That's the billion-dollar question, and that's what we're here to hammer out today. Okay, to really understand what's going on inside Paysign, you have to completely scrap the idea that it's just one single business. It's not. You absolutely have to look at it as two fundamentally different operations running under the same corporate roof. Think of it this way. You have the original foundation of the company, its legacy business. It's been there for years. And then you have this brand new, high-performance growth engine that they've bolted onto the side. And that engine is not just running, it is firing on all cylinders and shaking the whole building. Now, look at this slide. This is where the story truly comes into focus. The contrast is just stark. It's incredible. On the left, you've got their plasma compensation business. This is the old guard, the legacy operation that built the company. It brought in a respectable $45.6 million last year. It's solid, it's predictable. But look at that growth rate, 4%. I mean, it's not going backward, but it's certainly not setting the world on fire. It's barely keeping up with inflation. Now drag your eyes to the right. This is the Patient Affordability segment, their newer pharma business. For now, its total revenue is a bit smaller, coming in at $33.9 million. But the growth? Just look at that number, a staggering 167.8%. Let me be clear, this isn't just growth. This is a full-blown explosion. It's a strategic detonation that is fundamentally rewriting the entire narrative of this company right before our eyes.
Whoa, hold on a minute. I have to jump in here. You're framing this as a strategic pivot, but I see something different. I see a massive concentration risk. What you're really telling me is that one smaller part of the business is doing all of the backbreaking, heavy lifting, while the other, bigger part is just stagnating. To me, that sounds less like a fortress and more like a high wire act over the Grand Canyon. I mean, what happens if that high wire, the patient affordability segment, snaps? What if a regulator changes a rule or a big competitor steps on their turf? Suddenly, that 167% growth vanishes, and you're left with a sleepy company growing at a measly 4%. Relying so heavily on a single, supercharged segment feels less like a solid strategy and more like a high-stakes bet-the-farm gamble.
That's a completely fair challenge, a very fair point. You can have the most powerful engine in the world, but if you put it in a chassis made of balsa wood, the torque is just going to tear it to pieces. If the core of the company is weak, that explosive growth you're worried about could actually become a liability. So let's put that theory to the test. It's time to get under the hood, pop open the balance sheet, and really stress test Paysign's overall financial structure. We need to see if this foundation is built with reinforced steel or if it's just packed sand waiting for the tide to come in. So this number right here is the first piece of evidence that answers your question. While it's true the plasma business grew at just 4%, the overall company revenue, the whole shebang, grew by over 40%. That's a 40.5% jump year over year, hitting a total of $82 million for 2025. This shows that the new engine isn't just some small side project. It's become so powerful, so significant, that it's literally able to pull the entire weight of the company forward at an incredible speed. The growth from the patient affordability segment isn't just a rounding error anymore. It has fundamentally accelerated the entire company's trajectory.
And this slide is even more important. Because it's not just about selling more stuff, it's about how much money you make from those sales. This is about profitability. Look at the adjusted EBITDA. That's a key measure of cash flow and profitability. It more than doubled. It shot up an incredible 107%. This right here is what we hunt for as analysts. It's a beautiful thing called operating leverage. It means for every new dollar of revenue that comes in the door, a larger and larger chunk of it is dropping straight down to the bottom line as pure profit. This tells us the business model is incredibly efficient and it's scaling beautifully. They're not just buying growth at a loss. They are building a legitimate profit machine.
So how are they doing that? What's the mechanism behind that incredible operating leverage? It's right here in the gross margins. You can see the expansion clearly. They went from 55.1% in 2024 all the way up to 59.4% in 2025. Now, why is that happening? It's because that new, fast-growing patient affordability business is simply a higher margin operation. The services they provide in the pharma space are inherently more profitable than their legacy plasma compensation services. So as that pharma business becomes a bigger and bigger piece of the total revenue pie, it is structurally lifting the profitability of the entire company. This is the key takeaway here. Paysign isn't just growing bigger, it's growing better. It's becoming more profitable with every single sale. This isn't some temporary accounting trick. It's a fundamental improvement in the financial architecture of the business. And this is the final critical piece of the foundation, the capstone. Zero. A big, beautiful goose egg. That is the total amount of debt Paysign is carrying on its balance sheet. Zero. Think about that for a second. In this economic environment where interest rates are high and companies are leveraged up to their eyeballs, Paysign has a completely clean slate. This gives them an almost unfair advantage. It means they don't have huge interest payments eating away at their profits every quarter. It means more of their cash can be reinvested directly back into the business to fuel that growth engine. It means they can weather economic storms that would absolutely cripple a debt-laden competitor. A debt-free balance sheet is one of the biggest signs of a solid, well-managed structure, and it screams financial discipline.
Okay, you've made your case. I'll concede. The financials look exceptionally clean. Debt-free, expanding margins, serious operating leverage. You're right, that's a strong foundation. I can't argue with those numbers. But let's not get ahead of ourselves. No fortress is ever truly impenetrable. Every great structure in history had a weak point, a potential vulnerability that a smart enemy could exploit. So now it's my job to play devil's advocate. It's time to put on the black hat and actively search for the cracks in Paysign's armor, because they are there if you look hard enough. And you know what? We don't have to look that far. First and foremost, regulatory risk. That patient affordability business, their golden goose, it heavily relies on pharmaceutical copay programs. These are the programs where drug manufacturers help patients cover their out-of-pocket costs. Well, state governments are starting to scrutinize these programs, arguing that they might steer patients towards more expensive brand-name drugs instead of cheaper generics. A few unfavorable state-level rulings could seriously damage the economics of this business. Second, competition. This isn't a sandbox they're playing in. They are going toe-to-toe with absolute giants like McKesson. We're talking about a behemoth with infinitely deep pockets and decades-long relationships in the healthcare industry. That is a brutal war to wage. Third, you've got macro pressures. If a recession hits and big pharma companies are forced to pull back on their marketing and patient support spending, that high-growth engine could slow to a crawl fast. And finally, we come right back to my original point, that nagging over-reliance. That incredible pharma growth is doing a great job of masking the fact that their legacy plasma business is, for all intents and purposes, dead in the water. So yeah, the foundation looks strong today, but the path forward is absolutely littered with obstacles. The risks you've outlined are noted, and they are absolutely real. No one is denying that. But you don't build a lasting fortress by only looking at today's battlefield. You build it by anticipating tomorrow's challenges and opportunities. Paysign's management is keenly aware of these headwinds, and in response, they've laid out a very, very ambitious blueprint for 2026. This isn't just about hunkering down and weathering storms. It's about building higher and faster. So let's pull up their own forecast and see how it stacks up against what the rest of the market, Wall Street, is expecting from them. And right here, this is where it gets really interesting for a potential investor. Take a look at the numbers on this table. The analyst consensus, this is the average guess of all the Wall Street analysts who cover the stock, they're projecting revenue of about $99.5 million for 2026. Okay, that's decent growth. But now look at what Paysign's own management team is guiding for. They're telling the market to expect between 106.5 and 111.5 million. That is a massive gap. We're talking about a difference of $7 to $11 million. The company's own leadership is profoundly more bullish on their own prospects than the so-called experts on the street are. They're projecting 30 to 35% growth, basically signaling to the entire market that they believe the momentum is not just going to continue, but that it's actually going to accelerate.
And there you have it, straight from the horse's mouth. The CEO, Mark Newcomer, says, "We believe we remain in the early stages of this opportunity." The early stages. That is an incredibly bold and confident statement to make when your business segment just grew 167%. But here's the critical question you have to ask yourself. Is that the sound of confident visionary leadership, or is that the sound of dangerous over-optimism? See, it's one thing to put out a bullish press release with a big forecast. It's another thing entirely to actually deliver on it, especially when you're promising something so far above what the rest of the street thinks is possible. Can this management team actually execute on this ambitious blueprint, or are they inadvertently setting themselves and their investors up for a massive disappointment? All right, it's time to bring it all home. We've drilled down into the guts of the two segments. We've put the financial foundation through a rigorous stress test, and we've gone looking for the cracks in the armor. We've seen management's ambitious blueprint for the future and heard the skepticism it invites. We've laid out all the evidence on the forge. Now it's time for Iron Financial to deliver its final verdict.
So the most crucial takeaway is this. The Paysign that existed 2 years ago is not the same company that exists today. It has been fundamentally and structurally reforged in the heat of this new pharma opportunity. The verdict is clear. The strengths are powerful and undeniable. That pharma segment is an absolutely explosive growth engine. That engine is driving significant, structural, and lasting margin expansion. And this entire operation is built upon the solid bedrock of a debt-free balance sheet. By any measure, that is the definition of a financial fortress. However, the weaknesses are just as clear and cannot be ignored. That fortress effectively has one giant main gate, its profound reliance on the pharma segment. It is surrounded by very real threats from regulators who could change the rules of the game overnight and by giant competitors who have the resources to wage a long war of attrition. And let's not forget, the old part of the castle, the plasma business, is crumbling. It isn't growing. The structure is strong, yes, but it is not without its vulnerabilities.
Which all boils down to this final, provocative question. This is what it all comes down to. We've laid out the blueprints, we've run the stress tests, and we've analyzed the potential battle plans. The numbers show a company in the middle of a powerful, profitable, and profound transformation. But the shadows of regulation and the giants of competition are circling constantly. So the ultimate question you, as an investor, have to answer is this. Do you believe that new, high-torque growth engine is powerful enough to outrun those headwinds, to push past those risks, and to forge Paysign into a true, undisputed market leader? That's the call you have to make.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.